the Ellsworth Advisors monthly update. I'm Kelly Keenan. This is Cameron Mealy. Today we'll talk about what's happened in May from an economic standpoint, what we see moving forward over the next couple months, and then also how our portfolio has performed during the month. And we're going to kick it off with Cameron, talk about some economic numbers.
Thank you, Kelly. Morning, everybody. Hope everybody's well out there. Kelly, over the last month, we haven't really seen a change in kind of the tenor of what economists are talking about. It still appears that the biggest threat to the economy right now is inflation. And if you look at kind of the spirit of what people are talking about, it's really this discussion, Janet Yellen, that inflation is transitory has been basically thrown out the window. We do have an inflation problem in this country right now, and it's not just the Fed and easy money. It's a tight labor market, it's supply constraints, it's supply disruptions, it's a land war in Europe, it's global energy prices. We've got an inflation issue. The biggest question is, and what a lot of people are saying now is, unfortunately, this inflation seems to be much different than what we've seen over the history of this country. This is not something that the Fed can fix. In fact, a lot of people are calling the Fed powerless. What is the Fed going to do about it? What is their best tool in their toolbox is increasing the federal funds rate, constricting the money supply, and hopefully reducing inflation. We do have the Fed is meeting June 14th and 15th. It's their next Federal Open Market Committee meeting. The full expectation is that there's going to be at least a 50 basis point increase in the federal funds rate. I don't think any economist would be surprised if we even went a little bit above. I don't see us going above 50 basis points, but it could happen. We then have meetings in July and September. Again, the expectation is at both those meetings we could see another 50 basis point increase, which basically means over the year, we could see anywhere from 225 to maybe 300 basis points increase in the federal funds rate. By all historical measures, that is, unbelievably aggressive from the Fed. It's the largest, it would be the largest, at 300 basis points, it would be the largest 12-month increase in federal funds history, which is saying something about where they see us in this economic cycle.
Well, we're also coming off of levels at zero interest rates.
Yeah.
So, if you extrapolate that out, assuming they do another 50 in September and maybe more beyond that, right now the 10-year Treasury is at 3%. Let's say it gets in the 5% range, 10-year Treasury at 5%. Historically, that's
a little more normal.
That's still below average.
Yep.
So, the reality is we're going to have higher interest rates. Mortgage rates now are in just, over that 5% range, depending on a jumbo or not, right around 5%. To see mortgages at 6-7%, I don't think is out of the realm at all. And, once again, that's historically more normal, not the last 15 years, but, that's kind of the reality. So this normalization of interest rates, the big question, obviously inflation is on the forefront, is with what the Fed does, that push us into a recession? And does a recession really mean anything, or does it really affect what we're doing?
Technically, are we in a recession right now? Are we going to find out 6 months from now that we were in a recession?
Yeah,
it sure feels.
3 months. Yeah, we'll find out 3 months from now.
It sure feels like we are. We saw negative GDP in the first quarter. The revised rate from the Bureau of Economic Analysis, so this is their second reading on GDP, it came in at an annualized rate of 1.5%, a negative 1.5% in the first quarter. That was slightly negative. If you look at the Atlanta GDPs, the Atlanta Fed's GDP now growth model, as of June 1st, they're expecting second quarter to be a 1.5% annual increase. So obviously a swing to the positive, but still below the Fed's target of 2% GDP growth. Again, we still have inflation, which is now running. The April read on inflation was 6.3% year-over-year change. That was down slightly from 6.6% in March, but still 3 times higher than the Fed's stated goal on inflation.
What was it? February was like 8.9 or something? Yeah, so it's come down.
It's come down.
But it's still there, and as a reminder, inflation, even though inflation is lower, that doesn't mean prices are coming down. That just means prices are increasing at a slower rate. And I think we can expect to see a slower rate going into the end of the year. How much slower? I don't see it getting down to 2 by the end of the year, but where it's at now.
And is it because, the question is it because of the Fed or is it because of a slowing economy?
I mean,
what's taking
a lot of dynamics at play, a lot of cross currents, and not everybody's feeling the same pain. Is really what's going on. Is there's so many different dynamic forces in the economy that you can't necessarily rely on old models, or the history is not going to repeat itself. There'll be some similarities, but it's not going to be exactly the same as last time, and some people will feel the pain, some will not.
Yeah. Well, at the end of the day, I mean, what you have to say is you look at fuel prices now at an all-time high, it's hurting people out there.
Absolutely.
It might not be hurting, certain classes of people, but it's hurting people out there. And that's driving down consumer demand. It's driving down people wanting to dine out. It's hard to believe that we're at a point where a change in oil prices. I mean, I was talking to a friend who owns a business. He's had a couple of employees resign because they could find jobs closer to home to save on fuel prices. I mean, I can't believe, that's where we're at.
And there's a lag between when oil prices go up and then when gas prices go up. They follow, a couple months behind. So there's probably some more room to go to the upside of gas prices. That is a reality. And even with the retailers that have been announcing earnings, there's been a pretty quick shift as to what people are buying. So, Cam, you might be right. We could be in a recession right now.
We just don't know it yet.
We don't know it yet. Could be later this year, could be next year. And when you equate that to the stock market generally finds the bottom either right before the recession or early in a recession. But, talking about the stock market, there's probably more downside to go there too.
I would think so. I mean, I guess the positive note that we can really take out of this is if you look, employment continues to be strong. I mean, the unemployment rate was stayed constant at 3.6%. This is as of June 3rd. This is a report from the Bureau of Economic Analysis. June 3rd report showed that total non-farm payrolls rose by 390,000 in May. The unemployment rate remained constant at 3.6%. Notable job gains occurred in leisure and hospitality, and professional and business services, and in transportation and warehousing. Employment and retail trade declined. So you've got this, what feels like a slowing economy. You've got this kind of rampant inflation. You've got this, red hot jobs market where jobs are out there, employers are looking. It's a strange economic time.
Well, on top of that, you talk about positives. One positive is just read an article there. Bank checkable deposits, so money that's in the bank that can be taken out, withdrawn with a check. That number is at a number, compared to 2019, I want to say it was 40% higher than where it was in 2019. And what that means is the consumer's got a lot of money in the bank, but with higher prices, that money, that could keep us from going into recession until that money gets drawn down. And then where people are spending it, obviously at the pump, food prices and so forth, I guess with those, that inflation should naturally come down and that's also going to take the excess liquidity out of the system, which is the Fed's objective, obviously. So, inflation is going to calm down, but the reality is we're seeing a slowdown in the economy, and it's just how bad does it get? Is there enough tailwind to, push us through this year, or does it kind of smooth it out throughout the economy? Is really where we're at.
Well, and then you have comments by Jamie Dimon and Elon Musk where they, painted the economy in not a great light.
Right.
And, those Elon Musk can be a little bit more aggressive in his statements. Jamie Dimon is obviously usually very pragmatic. But, when you see people like that who know that what they say can influence the markets, they're feeling it and they're seeing it.
Well, the one comment Dimon had was, well, it's going to be a hurricane. I don't know if it's going to be Category 1 or Category 5.
Yeah.
And the other thing you always have to keep in mind, comments coming from Elon Musk, his specific businesses are probably going to be more effective than other type, electric car business, the space business. These are more speculative type businesses that require a lot of debt, and going into a higher, interest rate environment, he's going to feel a lot more pain than, a different type of business that doesn't have a lot of debt, that's cash flowing, well. So once again, where are these perspectives coming from? And knowing that different industries are going to get hit harder, you have to kind of put it into perspective as to, relatively speaking, what does that really mean? So yeah, those headlines, they don't look good, but you step back, okay, how is that going to affect, us as individuals or our clients? That's really what we need to focus on. We're not trying to make macro calls. It's really, what are we doing for our clients so that our clients can get through, this type of environment? And I think we're doing the right things.
And that's, of course, that's maintaining liquidity, having a good portion of assets in fixed income, and owning companies that continue to make money and grow year over year.
Exactly.
So.
What else do you have on your docket there?
I'm going to pass it over to you, Kelly.
Okay. May, kind of a crazy month in the market. We saw some lows for the year in May. We had a great recovery week prior to Memorial Day. Market made up a lot of ground. Actually, the Dow ended up slightly positive, 0.04% for the month, which on May 18th, you would have never guessed that was going to happen. S&P 500 up 0.01, so they both just cracked over. They, made a little bit of money during the month. NASDAQ still down 2.05%. The Russell 2000, which is small caps, was flat for the month. On the international markets, international stocks, developed world up 0.21. Even emerging markets gained about 0.114. So, a little bit of a relief in May. Things looked a lot uglier before the end of the month. We're starting to give it back a little bit this month, and it's going to be choppy. Bottom line, there's probably some more lows out there, but it's going to be back and forth. Year to date, the Dow is now down 9.21%, S&P down 13.3%, NASDAQ 22.8%, Russell 2000 down 17%, international markets down 12.8%. Emerging markets down 12.5%, obviously about where they were at the end of April. Our portfolios, dividend yield actually performed pretty well for the month. Dividend yield was up 2.6%. Year to date, we're down 3%. So that's held up really well compared to the markets. In May, Blackstone is up 16%, Verizon 10.8%, Pfizer up 9%, Alliant Energy up 8.5%, Edison up 8%. So a little bit of a theme. Energy companies, your utilities doing strong, your more conservative companies doing well. Laggards in May, Cisco Systems down 8%, Eaton Corporation down 3.9%, Waste Management down 3.6%. For the year, that portfolio, LyondellBasell up 25%, Merck up 21%, British American Tobacco up 20%, Edison up 18%. Once again, boring companies, strong cash flows, a lot of international business, just nothing sexy there, but they're making money, bottom line.
Profit is sexy.
Yes, exactly. Big laggers, Cisco Systems down 28%, Eaton down 19%, 3M down 14.2%, UPS down 13.6%. In our growth with income portfolio, which is more of a balanced portfolio, in May down 0.34%. Year to date down 5.25%. Exxon was a good gainer in there, up 13.8%. Microchip Technologies, 11.9%. Once again, Verizon, we have that in there also, 10.8%. Starbucks, a little bounce back, up 6%. Nucor took a hit in May, down 14%. Cisco down 8% again. Apple down 5.5%. Nike down 4.7%. Year to date, still the gainers. Exxon up 60%. PIMCO Commodity, our commodity exposure, up 31.7%. Nucor 16%, J&J up 6%, and Berkshire Hathaway up 5.7%. The big laggards, NVIDIA, which we made a ton of money on last year. We took gains at the beginning of the year, down 36.5%. Starbucks still feeling, I think, more as international pain, down 32%. Lennar, which is our home builder, good holding for us last year, but the home builders have gotten hit. They're down 30.3%. Disney struggling, down 28.7%. Nike down 28.8%. So, that's why we're down a little bit in that portfolio. Price potential, good month here, up 1.7%. Year to date, still down 5.6%. Big gainers, CarMax up 15.7%. Comcast up 11.4%. Analog Devices 9.6%. Lithium Motors up 7.7%. Year to date, we have another auto dealer in there, Asbury Automotive, that's up 4.9%. Laggers for the month, Intercontinental Exchange down 11.6%. S&P Group down 6%. Facebook down 3.4%. Stryker down 2.8%. And then year to date, in this portfolio. Facebook's been a big drag on the portfolio, down 42%. T Rowe down 34, Google down 21. Small caps struggled a little bit, even though the index was flat. We were down about 3% in small caps. Year to date, we're down 16. A lot of volatility in here. We did have a couple of big gainers. MYR Group up 15.8. Intel up 14%. StoneX up 10. But our laggards hurt us. Kaiser Life Sciences down 57. Mantech down 25. Ramaco Resources down 13.9. Year to date, some good news in here. Lantheus up 167%. Sierra Oncology up 67. Alico up 15. Once again, like Kaiser Life down, that's really taken on the chin there. We're down 71% there. Ramaco, we're still struggling there, down 33%. So that's kind of where we're at. I expect kind of more of the same. We are finding some good bargains, obviously, here and there with our stock picks, and keep the seatbelt on. I think it's going to be a choppy month.
But if you look, the portfolios have really held up well. They've done what you want them to do. I think one of the most important things that we need to remind people is that we are looking at this in a holistic approach. While you typically compare returns to stock-based, market indices, you can't be all in equities. So having your fixed income, PIMCO has performed incredibly well.
That's
and you
been
look
a
at
big
commodities, that's usually something, it's usually a tool in the toolkit that you don't see in a lot of 401k plans.
Right.
You don't see it with a lot of individual advisors who are using mutual funds, they're using small caps, international funds, value funds, but that commodity exposure was very important, and especially in an inflationary environment right now, that is really one of the keys that has made everybody's accounts hold up much better than the market.
Yeah, I like the longer term, 18 months, 24 months out. I think we're definitely making money. I don't think we're going to get burned too bad in the downswing. Even though there is more downside to come, I think when we do see that ultimate low, it's not going to stay at those low levels very long.
Yeah.
It'll hit a low. It'll quickly snap back up to some level. It's not going to hit all-time new highs, but the first leg of the snapback is pretty substantial. Then you start, kind of coming out of it. And if we're not, we don't feel that full downside, that's going to put us in great position when we look out 24 months.
Yep. So as always, hope you have a great month. We'll talk to you again. If you have any questions, please feel free to reach out to us. Have a great month.
Thank you.